Hello, clients and friends of MBP Sterling Partners. It's Jamie here on March 15th, and I'm coming to give you a market update after a few days of some pretty wild movements in the market following the collapse of Silicon Valley Bank. So over the weekend, SVB was closed down by the FDIC, the Federal Deposit Insurance Corporation. That's the government entity that insures and oversees banks. And it was a pretty wild time in the markets as a result of that. The interest rate markets, the bond markets, and the equity markets were all having a pretty wild time. I'm here to talk about it, a little bit about the banking sector in the US versus the banking sector in Canada, and then to get into some of the market movements that we've seen over the past 3 days. So, as always, if you do want some more in-depth analysis on this, or you want to discuss the specifics of your portfolio and how it relates to any of these events, please give us a call. We're always open to talk about it and review your specific circumstances. So let's get into it. Firstly, let's talk about the banking sector. The US banking sector is incredibly huge. There are over 4,600 FDIC insured banks in America. Now, that is a stark difference to Canada, where we've got only a handful of nationally regulated banks. We have lots of credit unions, but those are limited in their activities in terms of what deposits they can take on and what loans they can make. So we've got very different circumstances in the US. The consequences of 4,600 banks is that there are a lot of smaller regional players, and those regional players can also be concentrated by industry. So SVB, even though it was a top 20 bank, was both regional. It concentrated its business in California, and it had concentration in its depositor base in the technology industry. Now, we all know what's happened to the tech industry over the past year. It's been very tough. The NASDAQ was the first market to peak back in November and has had some pretty significant declines, especially for the smaller companies in there. And so the concentration of those depositors to SVB has caused it some pain recently. In Canada, we just don't have that. We've got regional diversity. We've got depositor diversity amongst our banks, both corporate, institutional, and individuals as depositors to the banks. They're coast to coast, and they vary by industry. But SVB had this issue, and over the course of the last year or so, as the bear market has hit the tech sector, deposits stopped coming in. So the venture cap companies that were funding these firms stopped raising money and stopped putting money into these startup firms. They continued to run their businesses, so they ran down capital and they ran down their bank account balances. And meanwhile, SVB's assets, so what they put those deposits into to earn an economic return, was largely treasury bonds and mortgage-backed bonds. And those bonds, given that rates rose over the past year, have declined in value. We all know that story. We've seen the returns in the bond markets, and Silicon Valley has been a victim of those negative returns. So all this culminated into an asset liability mismatch that had the feds come in and guarantee the deposits of SVB. Now, they did this largely to prevent any contagion to other banks. What's to stop any individual from saying, well, I bank at a small bank and I want the safety of being at JP Morgan Chase or Bank of America, and so I'm going to remove my deposits and put them at a big bank. Now, when that happens en masse, there's some big problems. Those banks cannot always create the depositors' cash instantly. And when a lot of depositors ask for it at the same time, that's what a bank run actually is. So the feds acted swiftly. They did it to prevent a bank run on a much larger swath of banks in the US. But the market has seen this as potential contagion. And so there's been a lot of sector-specific selling and a lot of changes in the interest rate markets or the bond markets as a result of the events over the weekend. So let's get into it a little bit. We're going to talk about the bond markets. We're going to talk about the Bank of Canada and the Federal Reserve and their path for interest rate policy going forward. So firstly, let's have a look at two-year yields. What we're looking at here is the Canada and the US two-year government bond yields, US in blue, Canada in red. Now, what we have seen was general trend towards higher yields, and we're all familiar with that. That's been happening for over a year now, as policy rates have ground higher and higher after the inflation that's gripped our economies for the past year. these 2-year yields have ground higher as well. But all of a sudden last week, that turned around. And in fact, it created a situation that we haven't seen perhaps ever, but certainly since the 2008 financial crisis, where people were just piling into government bonds. And they view that as a risk. Traders and investors view government bonds as a risk-free asset, one that cannot default. And so buying those assets send the yields down really, really quickly. It's been unprecedented, really, how fast these yields have declined and how much buying has happened in the government bond market. So much so that it's starting to affect the potential path of monetary policy. So what the Bank of Canada and the Federal Reserve, they look at markets as an indicator of where they should move, where the next policy decision should be. Now, they're also taking into account lots of other factors like economic releases and like the economy on the ground. They've got their models that tell them where interest rates should be. But the market has their own bets, and the market places their bets on where rates are going to be. So what we're looking at here is the market's bet on the April Bank of Canada interest rate policy setting meeting. So the red line is where the Bank of Canada overnight rate is today. You can see we're at 4.5%. And for the better part of this year, this chart is year to date. For the better part of this year, the market was expecting more likely to be a hike. And as you can see, the line hovers between about 450 and about 465. We typically see hikes and cuts come in quarter point increments, so 25 basis point increments. So it wasn't a lock that the bank was gonna hike in April, but certainly the probabilities lent towards a hike coming. Now, come last week, that changed immediately. And so now the market says the probabilities actually lie towards a cut. Now, we haven't priced in a cut yet. Our view is that the Bank of Canada will hold firm here. However, the market has swiftly changed from thinking that there's possibility of a hike to possibility of a cut going forward. When we look at this in terms of numbers, it's important to see that this is not only just the April meeting. The chart at the bottom here shows the probability, the implied probability from the market reaction of what the overnight rate is going to be after various Bank of Canada meetings over the course of the year. So the Bank of Canada meets in April, June, July, September, October, and December. And you can see that by December, the market is pricing in a probability that there will be between 3 and 4 cuts. So that's between 75 basis points and 1% cuts to the current 4.5 overnight rate. When we look south of the border, the same is true. Now, the market still thinks that we're going to see a quarter point hike out of the Fed over one of the next couple of meetings. There's going to be one next week and then another one in May. But then subsequent to that, the market is expecting the Fed to cut 3 times, so 75 basis points before January of next year. This is a drastic change to what we saw just a week ago. The market was largely expecting hikes and then a flat outcome for the balance of the year. And we would also point out that most of the analysts that we read were expecting the same thing. Analyst reaction to SVB's news over the weekend has been mixed. We've seen a lot come out and say we don't expect any change from the central banks. They're still fighting inflation, and the reality is that inflation is running hotter than they like, and employment is running hotter than they like, so they have no choice but to continue to raise rates. Other analysts have said the possibility of contagion is too great a risk for the Fed and the Bank of Canada to ignore, and they're going to have to cut accordingly. Now, we're not sure where this lands. We tend to think that the Fed and the Bank of Canada are going to hold steady here, be data dependent, and see how much additional reaction the markets are going to have out of this SVB news, and we're going to see what happens in the next few weeks, and particularly at the next Bank of Canada meeting. So on to the equity markets. The TSX, this is a 1-month return for the TSX and the subsectors of the TSX index. As you can see, financials and energy, as well as healthcare, we'll ignore healthcare for now, but financials and energy are right towards the bottom of that list. And that's important because those are huge sectors. They're very heavily weighted sectors in the TSX index. Upwards of 2/3 of the index is valued on financials and energy. And we've seen a lot of selling in those. Now, oil has been selling off for the last week, and that's caused some of the pain in the energy sector. That'll be the subject of another one of our videos. But we're focusing on the financials. So the Canadian financials have sold off in sympathy to what's gone on in the US. Again, we don't feel that there's actually any fundamental problem with Canadian depositor institutions. We just think this is the market selling off in sympathy. In the US, I've chosen to focus on the Russell 2000 index, which is the small cap index, as opposed to focusing on the S&P 500, which is the large cap. The reason is that most of these regional banks are part of the Russell 2000. They're small cap banks. They tend to be more heavily concentrated within that Russell 2000 index. So when we look at these month-to-date returns, you can see that they're terrible for the financials, down 12.5% over the month. Is really a really bad outcome. I don't think I need to expand on that anymore. Year to date, it looks pretty ugly. Even though the Russell 2000 is now flat, it's given up all of those nice January returns that we saw. Same thing can be said for the TSX index. What we've seen in financials in particular has been pretty terrible. At the bottom there, we see the utilities. Utilities like lower rates, so we've seen some buying, or at least some less selling of the utilities and the consumer staples sectors. That's considered defensive sector. So traders and investors have been rotating out of the financials and energy into the more interest rate sensitive sectors that have seen a tailwind from this market activity. Well, that's all we've got for today. I'd like to thank everybody for joining me for this quick market update. I'd also like to remind everybody that while we were talking about the broad markets today, these aren't necessarily indicative of your individual portfolios. We employ a diversified strategy at MBP Sterling Partners, and we do that specifically to avoid any risk that might be specific to one industry. We own equities, bonds, and alternatives to employ that diversified strategy. And this is why, specifically why, in case we see a specific sector that feels some pain on any given day. So thanks for joining us. As always, I'd like to invite you to reach out to us if you want to have any further discussion about your portfolios. We'd love to hear from you. So have a good day, everybody.